Welcome to Bear Investing. So this is just another portfolio update that I do every single week. So the S&P went down 1.5%. The S&P 500 went down 2.81%. So both the Canadian and the American markets went down. The American markets are going down more than the Canadian. So I actually just purchased American stocks this week for the most part. And we're going to go through what I purchased, and we'll go through the earnings of both Google and Microsoft, which were pretty major earnings that happened today. So with that said, if you want to keep up with the updates from week to week, subscribe to the channel, like and comment on the video. It really helps get it out to more people. And let's roll the intro and then get into the update. Let's start off with the Rrsp, which is my smaller account at $316.42. All time we're down $33, about 10%. We only hold Starbucks in this portfolio, so we bought it around the mid 80s range. It keeps declining along with the general market, but I'm going to continue to buy this because it gives me a good dividend yield. I'm pretty happy paying this price, so I'll keep averaging into Starbucks as long as I think that it's a good value. I think right now it's a pretty decent value, at least in my opinion. So in our TFSA, we have $13,029.19. So we're having a pretty brutal month, just like the rest of the market. We're down $869.22. They're down about 6%. All time, we're still in the green by about 591.89, or up 5% all time. Again, not worried. In fact, this is a great time to be buying stocks. The worst time to be buying it is when everything is up and on a huge run. You want to be paying less for your stocks, whether you're in growth stocks or you're earning dividends. It's better to pay less for something than pay more for something. So I'm always excited to pay less. So Apple's actually in a pretty big dip right now. They're going to have their earnings on Thursday, so we'll see how they do. There are also rumors that they're going to raise their dividend on Thursday, so let's see if that happens. That'd be really nice because then I'd get a raise for doing absolutely nothing, which is a great way to get a raise and get paid for doing absolutely nothing. AQN is holding up pretty well in this volatile market, so you can see that more defensive stocks are holding up better in this market sell-off that we're having. Alibaba's doing absolutely terrible, and China's locking down Beijing now. So they're locking down more and more of the country, and I think it's going to hurt like Chinese businesses and any company that has any sort of warehouses or stores in China. But a lot of major companies do, so it affects more than just the Chinese companies that are in China. It's going to affect global brands that have presence in China too. So that's something to look out for. Brookfield's in a pretty big decline too, so I'm kind of interested in getting more of this. And the banks are also in a dip, but I'm going to be getting dividends from these soon, so I'm just going to reinvest those back into the banks. And then with the income funds, I didn't change anything. So I actually bought more Google. They reported their earnings, and I'll be getting into that now. So Alphabet, which is basically the company that owns Google, had a little bit of a miss on their earnings expectations. So the shares did drop 4.5% after the following results. So they reported these earnings. So slight miss on revenue overall. So 56.02 billion is what they made. 56.07 is what they were expected to do. That's a very small miss. I don't think that's a big deal. And so for the first quarter, it says that they grew their advertising revenue by 22% to reach 54.66 billion. The only downside to this would be their overall growth from YouTube, which is a very popular platform, the one you're watching right now. And so it just grew revenue by 14%, coming up short of estimates of 7.4 billion. So they made 6.87. They just did 7.4. And they said that this unit had been a faster growing segment of the company in recent quarters, and in the same period last year grew revenue by nearly 49%. So that could actually be due to the the lockdown that we were having. I'm thinking that more people were stuck at home or at work from home situations watching more YouTube. So it's possible that it just grew their usage overall, and that's just not sustainable when we open back up, and that demand is going to fall down a little bit. So that could also be why Netflix is losing subscribers as well. So it's interesting to see that it's affecting like Google as well in a way. But I'm not worried. I mean, YouTube is going to continue to grow anyway, even if it doesn't grow. It's not going to grow at 49% indefinitely. That's just impossible. It's going to grow at the rate that it's going to grow at. The advertising revenue is still good, still saw like over 20%. And the article says that for YouTube specifically, increased competition for social media companies and new streaming platforms has created further risks for future growth. So they're saying that TikTok is picking up a lot of market share among 18 to 24-year-olds. I mean, this is to be expected. I mean, I think it's safe to say people have very short attention spans nowadays, and but I would say TikTok is more for just short videos. It's not really. I mean, it's an alternative to YouTube, you could say, but I mean, there's a difference between wanting to watch like 10 to 30-second clips and wanting to watch like a whole YouTube video. And I would say the videos on YouTube are generally a lot higher quality in general. And with Google Cloud, they are still growing it. So this says that Google Cloud grew 43% to reach 5.8 billion, which is in line with expectations. However, operating losses were wider than expected at 931 million, and Wall Street expected a loss of 893 million. So Google Cloud is still not it's still not profitable for Google yet. They're still investing in it, so the operating costs seem to be a little bit higher than Wall Street was expecting. So again, another thing knocking down the stock. But overall, it's still pretty good, and analysts still think that the cloud services can grow north of 30% well through 2023. So Google still overall is growing pretty fast. Like if you take all their segments together, maybe like between 20%, 25% growth. I mean, this is pretty good for a very large company. And I think it's trading at a good value, and that's the reason why I purchased more. And I mean, if people are going to sell off and get out of this quality business just because, their expenses for Google Cloud was a little bit higher, and YouTube didn't grow at 49%, which honestly is impossible every single quarter. Like, this is not going to happen from year to year. That kind of growth is just not sustainable. I would say like, between 10 and 20% annually for a long period of time is probably more realistic for that. And a little nice silver lining to that earnings miss and the sell-off is that Alphabet actually announced a $7 billion share buyback that they're planning to do. And if the stock continues to decline, I think this is a great use of capital because, Alphabet has $140 billion sitting there. They don't really have a place to invest it. So this is actually a great way to make a good return in buying back shares of your company. So this is good for shareholders. It just increases my ownership of Google without investing any more money. So this is great news. And one of the reasons why I wanted to buy Alphabet was because of the share buybacks. And I purchased 5 more shares of HYLD. So again, the American markets got beat up, so I decided to pick up more of this to get an over 10% monthly dividend yield for 7 different U.S. listed ETFs. So they only contain U.S. stocks. So you got a good mix: S&P 500, small caps, gold, technology, you name it, it's got it in here. And we also noticed that a company like Loblaws is holding up pretty well. So the defensive stocks are still holding up pretty well. So that's why like Coca-Cola and Pepsi are holding up a little bit better. We'll see if that continues. If it's a true, market crash, then everything would decline. But it seems like people are just, keeping money in these, I guess, more lower risk defensive bets rather than the high growing technology sector, which people are just scared of any amount of risk right now. And then I also bought more Microsoft, so it dropped into the low 270s. So I decided to buy more. They actually had excellent earnings. And yes, Microsoft beat their earnings yet again. They just do this every single time. It's really not surprising. They're consistently just doing this all the time. So their earnings, they beat expectations. So their earnings per share 222, 219 was expected by analysts, and their revenue was 49.36 billion for the last 3 months versus 49.05 expected. So they beat on both earnings and revenue. So revenue increased 18% year over year, compared with 20% in the previous quarter. And it looks like they spent a little bit more on sales and marketing, so 10% higher than the year ago, and the fastest growth in more than 3 years. So that's interesting that Microsoft's spending a little bit more on sales and marketing. Could be maybe they're trying to reach more customers, so that's something to note. And the Intelligent Cloud segment, which contains Microsoft Azure Public Cloud for SQL Server, Windows Server, and Enterprise Services, generating 19 billion in revenue. So that's up 26%, which is very good growth. And Microsoft Azure, the secret growth that Microsoft has. So that grew 46% in this quarter, compared with 46% growth in the prior quarter. So they're still maintaining that growth rate. The expectation was 45.3, so they beat that expectation again. And 46% is nothing to laugh at. That's very, very fast. That's actually a higher growth rate than we're seeing with other companies. And Microsoft is just seeing growth across the board in multiple different segments. And this is just a solid income earner. And with their subscription revenue model, it's just a business I can see myself owning for the long term indefinitely. So I'm very comfortable buying Microsoft as it declines. And if we go into the dividends earned, we've earned $451.44. Each year we're making $698.54. So if we compare that with last week's total, we made $689. So that's an increase of about $9 of income just from the last couple deposits and reinvested dividends that we did. So pretty nice. Every month we're making $58.21. Last week it was $57.42. So again, another increase. Very nice to see these numbers go up slowly over time. Weekly we're making $13.43. Last week was $13.26. Daily we're making $1.91. Last week was $1.89. So an extra 3 cents per day. We're definitely extra 2 cents per day actually, but we're getting closer to that $2 a day goal to hit $60 a month in passive income. And for my hourly wage, if my portfolio worked a 40-hour week job, it's going to be making 34 cents per hour versus 33 cents. So I'm just going to continue the strategy of dollar cost averaging into the market each and every week, and just increasing my dividend snowball machine that I'm building here. And the longer the market stays down, I actually hope it goes lower, but that's because I have no issues holding these stocks for very long periods of time and just collecting the passive income that they provide for me. And even with these stocks that don't pay dividends, I believe that they're currently undervalued, and I expect solid returns in the long term, 5-10 years from now. So with that said, if you enjoyed the video, feel free to use my Wealthsimple link in the description below, because it's not a bad time to get into the market since everything's down right now. So there's some good deals out there. You can get a free stock worth up to $4,500 if you fund a personal account using that link below. And please like the video, subscribe to the channel, and leave a comment. How are you doing in this market downturn? And what are some of the strategies you're using? I'm just continuing to dollar cost average into the, best value positions that I can see. Right now, I think that's the American stocks and specifically the technology sector, and that's why I focused my deposits on that sector in particular. I'm just going to stock up on what I think is the best value at the time. And I'm also a little bit underweight in tech. I want it to be a little bit higher in my portfolio. So have a good day, everybody, and Well, let's see where the market heads tomorrow.